Today, we are excited to welcome our good friend Rex to the podcast. He has been in the mortgage industry since 1998, so there's almost nothing Rex hasn't seen or done in the real estate industry. So we really are looking forward to having Rex on the show to talk about the ins and outs of government loans versus conventional loans and why sellers should be excited about getting offers with these types of loans. So stick around and let's hear what Rex has to say. Hi, and welcome to Talking Realty, the go-to podcast for home sellers looking to make more money, save time, and avoid headaches. Whether you're selling a flip, a new build, an income property, or the place you call home, you're in the right place. I'm your host, Glen, 20-year realtor and founder of the Ohio Property Group. Most home sellers hate paying huge commissions to realtors. At the Ohio Property Group, we do the same things as all other realtors, but instead of charging a 6% commission to sell a home, we charge a low flat fee. So our sellers save thousands of dollars and get better results. To learn more, head over to talkingrealty.com to pick up our monthly newsletter or any of our free home seller tools. And if you haven't already, please subscribe to the Talking Realty podcast so you never miss a thing. Now, let's get to it. Today's guest is a mortgage broker named Rex. He has been in the mortgage industry since 1998. Since then, he's financed well over 3,000 properties. He's actually done homes for me, for Tasia, for Justin, so we know this guy pretty well. Rex joined Union Home Mortgage in 2010. He's held a real estate license. He's worked in the appraisal industry and in the title industry. He also has invested in real estate over the years and owned approximately 30 properties, including single-family, multifamily, vacation rentals, flip houses, and commercial. There is very little in the world of real estate that Rex has not touched. So without further ado, let's bring Rex onto the podcast. How you doing, Rex?
I'm doing wonderful.
That's great. That's great. Well, thanks for making the time. I know we're kind of excited about this particular topic just because we run into it a lot.
Sure.
So before we jump into it, though, do me a favor and I know a little bit about your background. Actually, I know a lot about your background, but for those that may be listening in that don't know you, maybe tell me your story. You know, how did you get here? How did you get into the business, and why Union Home? Start wherever you like.
Sure. So this is my second career. My first career was in the marina business. I was in service management for a yacht club and loved it, but bought my first house and it was mid 1990s.
Mm-hmm.
And it was a nightmare. I hated it. It was such a pain in the butt, but all I did was go to the local banks and lots of denials and turn downs and run around and man, it's just this shouldn't be this hard.
Right.
So that got my interest. I mean, I started talking to some folks after the fact. I mean, I did buy, the home. Of course, now knowing everything I know, I do look back and give them a little bit of credit in the fact that I was buying a manufactured home in a condominium association. Talk about an odd bird to begin with. But it was on the lake. It was on Lake Erie. It was waterfront stuff, and that just adds a lot of complication. But kind of dove into just interest in real estate and the financing side of things, and so ultimately I had enough interest that I did start writing loans. Actually, August 1998 was my first loan that I originated, and got involved in the brokerage business. And then in 1999, I left the marina world and went full-time, jumped in feet first and just started doing loans and never looked back. Wrote everything out. Everything was great up and through about 2007. And then that's when things started to turn a little bit ugly in the real estate world. And of course, the big crash in 2008. And then you kind of muddled and treaded water for a little while and decide, do I stay? Do I go? And decided to stay. And part of the big decision to stay was when I walked through the doors at Union Home Mortgage in Strongsville, Ohio. It felt like the entire world was lifted off of my shoulders as far as the real estate finance world was concerned. It was tough. It was really, really tough then. But they had the right attitude. They had the right surroundings. The owner of the company had the right vision. And it really did kind of work well with my own personal vision. So I joined Union Home Mortgage in July 2010. and have not looked back. And I do know that I picked the right home to continue my profession and build everything I already knew and make it bigger and better.
Yeah.
So that's kind of where I came from, and that's where we're going, and that's why I'm where I'm at now.
Yeah. I remember I still have nightmares about 2008. So I
Yes.
just wake up in a cold sweat every once in a while, check the calendar, realize I'm okay. So how are we doing today in terms of the market? How are things looking?
I think things are great. I mean, I personally think we have a great economy.
Mhm.
I know there's a lot of naysayers out there worried about inflation and those types of things, and I do believe obviously that has an impact. There's no doubt about it. Of course, being in as long as I've been in this business and watching the trends going up and down, we're very strong. I mean, the job market's great. If you want to be employed, you can be. Things can happen. There are people that want to buy every day. I get applications every single day, multiple applications from people that want to buy homes. Still have an inventory shortage, and because of that, you got a strong demand and a small supply. Our job's secure. Rates are heading, I think, in the right direction over the next few months. We watch that stuff really close, and I think there's a lot of opportunity there. So aside from the market I think it'll heat up next year personally a little bit. I don't think it's going to take off like a rocket, but I think it's going to be a better year next year than what we had this year. A lot of that driven by rates and people sitting on the sidelines that are going to come back in and jump into the game. But also from the mortgage side of things, we have a lot of folks we financed over the last 2.5 years that we're going to be looking to refinance. So I think next year is going to be a busy year. And, it's all going to have a factor and, getting things done and working with loan officers that want to handle their purchase business as well as maintaining their existing clientele, because sometimes they get a little sidetracked with the refinance and they lose their focus on the people that keep them busy every year.
I think there was a period of time where we thought, refinancing was probably never going to happen again, of course, because rates were so low for so long. But to your point, things drifted up and now they're coming on back down. I know we've talked offline a little bit about interest rates and, and none of us has a crystal ball. At least, wait a minute. Do you have a crystal ball? I've been looking for one. You don't have one, do you?
Well, I have one, but it's not very clear.
Fair enough. I use my magic 8 ball for everything. So that's
Yes.
that's the best I've got right now. But anyway, so where do you think, do you see rate cuts coming or any, I mean, what's your ear to the ground say?
We're watching it really close right now. I do get a lot of interest in refinancing right now
Mhm.
because I hear that the news is always touting that, rates are coming down, the Fed's going to cut the rates. And, they've come down off their highs, but they're still not really low.
Okay.
But most economic forecasters, people that I believe are smarter than I am, they really do think that the Fed's going to come down a quarter here, a quarter there, quarter of a point, 25 basis points, or maybe 50 basis points. And that's going to happen over the next 3 to 6 months. Maybe we come down 1% from where we're at now. And I think that's kind of a realistic expectation. Personally, sometimes I don't agree with them, but I think right now that's probably realistic. We got to get through the political climate that we have coming up in November, and then we'll see what happens after that.
I hear a lot about, and we didn't talk about this ahead of time, but I hear a lot about pricing the rate cuts in. Are you familiar with that phrase? We're
Pricing the rates, yes.
kind of, yeah, for the layman like me, explain what that means, because I see that phrase a lot.
So really, everything's speculation. Some people
Yeah.
say that about the stock market too. And, so the rate cut that is probably coming in September is already pretty much factored into the rates that are going on now, the pricing of that. So pricing is interest rate and or the cost of that rate to obtain that rate, which, in turn is closing costs for the buyer side of things. But for the most part, I think they've already baked in what they think that the pricing is going to look like with the cut that's anticipated in September. The big question, most of the conversations now are, what do they think will happen by December?
Okay.
Because there will be a couple more meetings between now and the end of the year from the Fed or the Federal Reserve, and that's where the big what if is, and we're kind of watching the markets to see what the forecasters say.
Got it. Well, Well, lest we get too deep in the weeds. For the topic at hand today, we were going to talk about some of the misconceptions surrounding government loans versus conventional type loans. And I don't know anybody personally who knows more about this stuff than you do, which is why I called you. And what prompted all this is that some of my sellers are very hesitant to even consider any sort of offer that's got a government loan, whether it's a FHA or VA or whatever type loan, and they have some myths around it. So I thought I would give you a call and see if maybe you could help me deconstruct this a little bit. So to start, how would you define the different loan types, just sort of in a nutshell?
So basically, like with us here at Union Mortgage, we only do what's called agency loans. Agency loans are going to be conventional, just going to be based on Fannie Mae and Freddie Mac. And then we have FHA, USDA, and VA. Of course, the FHA, VA, and USDA are all government insured, government-backed loans. And those are the ones that I think you're referencing that sellers are a little more reluctant to entertain. As far as a new buyer is concerned, there are a few other things that are out there with some local banks, in-house financing stuff, and we probably really won't cover that today because it's just all over the board and they do their own thing. But for the most part, most buyers are seeing offers coming or presenting offers to sellers, I should say, that are going to come from one of those sources, either conventional, FHA, VA, or USDA.
Okay. So at a high level, though, what separates the FHA, VA, USDA from conventional loans? We refer to FHA, VA, USDA as government-backed versus conventional, which are presumably not government-backed. Are you able to kind of tell me where does the
Yes.
government fit into those loans?
Sure. The government backed means the government has an insurance program set aside basically to help mitigate loss from a lender who's willing to make these loans.
Mm-hmm.
So that also kind of puts a shadow over some of these loans that makes people think that maybe they're the less than strong buyers acquiring these loans, and that's not always the case.
Well, I got questions about that, so we'll get
Yes.
there.
Yeah. And then one other thing too is we can pretty much separate the FHA, VA, USDA into two categories. We'll put FHA and USDA into one and VA in the other, because VA is pretty much strictly for veterans who qualify for that benefit of being, in the military or providing services as a contractor to the government or something. So the veteran program, again, very strong loan for the buyer side of it is different from the other two just because the average individual cannot get a VA loan. They do have to have a military background.
You got to be connected a little bit through service. Good. So why might a government loan be more attractive to a buyer, or why would a buyer choose to get? I mean, I get the veterans, but just looking at conventional versus FHA or conventional versus USDA, why might a buyer choose one over the other? And I guess what I'm driving at here, Rex, is some sellers may assume that it's just because they can't get a conventional loan. You're telling me that's not true, that they may choose an FHA or USDA over conventional, even if they qualify for both.
Yes.
Okay.
So most of it has to do with that pricing, kind of some of that stuff we were talking about just a second ago. If I take, let's say, an average buyer, not somebody that's got bad credit, not somebody that's super strong credit, if you put them in an FHA loan, more times than not, their monthly payment is going to be less than it would be with the conventional loan. Conventional typically really does cater to kind of the higher end, cream of the crop type of a buyer, maybe a little larger down payment, although that really has been kind of reduced these days as well. But higher credit scores. Credit scores are a really big factor in that. And then that credit score factor not only plays into the interest rate, the pricing again, when it comes to the conventional loan, but then you have a whole nother third party that's involved. If you're not doing 20% down, you have this thing called PMI, private mortgage insurance. And that is not part of Fannie Mae or Freddie Mac. It's another company, and they're looking at the demographics of that loan, not only credit score, but they're also looking at debt to income ratio, and they're going to price that accordingly. So your PMI can range drastically on a conventional loan versus USDA and FHA. That monthly mortgage insurance component. They each have their own names for these things, but just so people understand, it's basically the same thing. It's a set number. It doesn't matter what your credit score is. It doesn't matter what your DTI is. It's always the same amount, and it frequently is lower than what you're going to get in the conventional world. So you could take somebody who qualifies for FHA and USDA, and they may also qualify for the conventional loan, because conventional can go to as low as 3% down. So cash out of pocket really isn't as much of an issue. But at the end of the day, they may have a payment that's going to be quite a bit higher than they would if they took that government-backed loan. I just looked at one this morning. It's a veteran, compared side by side, conventional to VA. Actually, it was construction, and the conventional loan was going to be about $300 more a month for the exact same house than it was if I took them VA.
That is a significant amount. And, from the sell side, that means a buyer could potentially make a higher offer, pay more for the house, because their monthly payment would be lower. Did I make too big of a leap there?
That is an absolute great statement, and that is absolutely true. Aside from just the buying power there, conventional is also more constrictive on their maximum debt to income ratio. The government loan guys will let you stretch things a little further. I don't want to make that sound like it's a risky situation always.
No, I know what you mean.
Sometimes it can be, but there's various scenarios that happen that, again, if you got debt to income limits between those different loan types, that can have a huge impact to that. And again, now you're being able to put a buyer in there who, aside from affordability and price point that they can get to, you're making a weaker buyer essentially buying that same home by forcing them to take a much higher payment just because, you may not be willing to consider a government loan for them. Okay. So if you're concerned about a weaker buyer buying your home, sometimes that seller could be forcing a weaker buyer than they would if they would allow that government loan to actually transpire.
Yeah. Wow. So if we lop off the serious extremes, most of the folks in the middle, is it not necessarily true that I guess I've even thought that maybe it would be more difficult to get a conventional loan than an FHA loan or a USDA loan, and that's not necessarily the case.
No, I don't believe that's necessarily the case. All the loan programs for the most part they've relaxed. It's pretty easy to get each of the loan types. It really comes down to the financial benefit of each loan program that's out there for your typical borrower.
So when we're seeing multiple offers come in on a property, we always call out the type of financing, and maybe we need to do a better job of explaining to our sellers that, hey, we're just letting you know, and we'll get to property requirements here shortly, but that as far as just looking at the buyer to buyer to buyer side by side, we can't necessarily draw any conclusions from the fact that one buyer chose to go with conventional versus VA versus FHA. We just can't make that leap based on what we have in front of us as a seller's agent.
Correct. I would agree with that statement.
Okay. So, we have some sellers, and I just really want to stomp this fire out in case I'm on a mission today. We have some sellers who will come to us and they will say, I don't even bring me offers unless it's conventional or cash. Now, there are a few instances, and I don't want to go too deep into it, where that makes sense, maybe because of the property requirements, or because of the flip rule, which we'll talk about in a little bit. But on a clear blue day, without those two asterisks, there would be no reason for a seller to say that to me and have it make sense. Is that I could argue back, that's probably not a good idea, because when we restrict the number of buyers, we invariably lower the price that we're going to get. We know that, but can you think of any reason legitimately other than the flip rule or maybe a house that's just going to be a tough sell because of its condition, that a seller would not want to see those?
Yeah, there's obviously property condition usually is kind of the driving force to that mentality. It's like, I
Okay.
don't want to fix anything, even though there might not be anything wrong with the house. It's just the mentality that they're going to come up with extra work to be done. And then on top of that, one of the fastest growing segments of the financing we're doing is, rehab and escrow holdback and all these other things to fix whatever needs to be done. Because
True.
each of these programs have some sort of, program or, addendum kind of you can do to be able to, fix whatever needs to be done. Because most of the fixes are usually small to begin with. But we do a lot of rehab loans and we do a lot of escrow holdback so that we can get things closed and do the repairs, whether it's before closing or after closing. So there's a lot of options there, with a little extra work, again, possibly selling for a lot higher price and still getting it all done and
Okay.
making everybody happy.
Well, I mean, we kind of opened the door on property requirements, but from a high level, what are the general property requirements? I mean, what's the concept of property requirements really? Why is the government doing this on some of these loans? And are they just unique to government loans?
Most of the time it is really focused around health and safety. Um, I know I shot you over kind of a list of my common appraisal
Mhm.
things. I mean, the true handbook they use is pretty lengthy and several pages, but the most common things that we see are just small stuff, a little bit of chip paint, maybe changing an outlet in a bathroom or a kitchen, adding a tube on the side of a hot water tank, just to get, safety issues to get this overflow spray down to the floor. Most scenarios we get, most appraisals we get, because the appraiser a lot of times will put in their potential cost to cure, um, usually less than $500, and many times
Mhm.
it's less than a couple $100 to fix whatever needs to get fixed in just your average house to get it to pass FHA or VA or USDA. But with all of that, and a lot of people have really kind of lost their understanding, especially agents that have been in the business for a while. They just assume you go to conventional and you just kind of wipe the slate. You don't have to worry about any of these things. And that is rapidly changing right now. Fannie Mae and Freddie Mac are both cracked down on appraisals. And I have literally had conventional appraisals come in where we got called for chip paint. And it's not because of the lead part of it that's usually what everybody thinks of, but it's because of weatherization. If the paint's peeling off, you got exposed siding, if it's wood or something like that. And so appraisers are starting to call those as well, especially on exterior surfaces, because if there's somebody comes back and does um, like a review of that appraisal, which happens frequently, a lot of people don't know this, but Fannie Mae, Freddie Mac, or any other agencies may send other appraisers out to do a field review of an appraisal even after closing, and
Um,
yeah, so appraisers are getting revision requests for appraisals on homes that have sold, closed, paid for, loan done, and yet the appraisers are still doing work on that property because they might not have wrote something down that maybe they should have. So conventional is not an easy sweep under the rug. It's like, yeah, we don't have to worry about any of these things because that is becoming a little bit more prevalent. It's still a small amount. It's still nothing like the government loans, but the government loans, typically the repairs are minor in nature. If it's major, such as a roof or something like that, you have the same issue with conventional. They won't close on that either if you don't have a good roof on the thing. The difference between them from the appraisal standpoint typically is a little bit of work, if any at all, and so when you start balancing out, do I spend an extra $500 to fix some things so maybe I can sell the house for an extra $2, $3, $4, $5,000? Personally, I'd rather spend $500. That's a great return on my
yeah.
investment.
And we tell sellers, I mean, we get a few fixer uppers now and then, not like we did years ago, but we get properties that need a little bit of love. And our kind of rule of thumb is if it's broken, fix it, just in general. I mean, to your point, it's, when we run into issues during inspections, particularly when I find out later the seller knew about them, it creates a lot of problems, not only for the deal, but the trust between the buyer and seller, and now you're on the clock. I mean, it's not like you can take 3 months to go get quotes and wait for the cheapest contractor to come around. You're going to be paying premium prices to get that stuff fixed. And so I'm with you. I think if there's something wrong with the house, let's not, first of all, pretend that if we just accept cash and conventional, well, cash for sure, but if we accept conventional over government buyers, that we're going to not have to worry about those things because, to your point, a bad roof is, or a bad furnace that's clearly not working or clearly at the very tail end of its life is going to be a problem almost everywhere for everyone. So if there are those problems though, so let's kind of pause right there. You know, you've got a house that needs a furnace or needs a new roof and it's needing it now, not later. Um, and the seller doesn't have the cash or doesn't want to part with the cash to do this. Are there remedies or are we kind of stuck with cash buyers at that point?
Absolutely, there's remedies. I got a couple right now in process that, we found stuff out and
Mhm.
we're just going to put money in escrow. We're going to take care of it after closing. So we close the thing out. Sometimes the sellers do fund that to be able to take care of afterwards because they don't have the money up front. So
Mhm.
we'll close. They're getting their proceeds. And we'll fix the things later. So there's definitely options to work through that. Just working with a lender that has all of that stuff available to them.
So those options, are they available only through the conventional side or are those options, did I hear you say they're available through the government loans as well?
Yes. So we actively do stuff with conventional FHA and USDA for escrow holdbacks and with actually rehab programs. VA is a little bit more funny about some of that stuff. We can do escrow holdback with VA, and that we do frequently, but like a rehab program through
Right.
VA, and we don't offer it. I know it's available out there in the industry, but yeah, so all these programs do have ways to work through that to get these things resolved after closing, if that's the scenario that needs to happen.
So just real quick, how does that work? So I've got, let's just say I've got the equity, but I don't have the cash if I'm the seller. And I
Yes,
know that it needs a new roof and let's just call it, I don't know, $10,000 just for the sake of this conversation. And I've
sure.
got at least that in equity if I sell it for whatever. So I would then necessarily sell it for a higher price because the buyer's getting a home with a new roof eventually. And then out of the seller's proceeds, we would just hold back money. Who holds that money? Is that like the title company or does the lender hold it?
Each lender is going to be a little different. Some of them will have the title company hold it and then give them
Okay.
permission to release. Others will actually hold it in-house at the bank. So that after the repairs are done, they're usually going to send that appraiser back out or whoever to verify the work has been done,
Sure.
and then they'll release the funds. A lot of times, kind of be prepared. The bank's probably going to want to hold a little bit of extra. They're going to hold contingency money in there just in case, because typically repair type work, it's not uncommon to rip a roof off or rip a wall out and realize, oh, we've got carpenter bees or we've got this or that. You want to make sure there's enough funds there to take care of any unexpected expenses in that process. And then that extra money that's held, though, is typically going to go back to whatever source provided it. So if you had that $10,000 roof job, we may hold 15,000 in the escrow account. And when the work's done, and if they only spent the $10,000, $5,000's left, that money is going to go right back to that seller after all the work is completed. So it's just additional funds getting back to them when everything's taken care of. And of course, in that scenario, is after a closing.
Who kind of drives that? So, I mean, we're inspections. Let's say you're my lender and I've got the listing and, okay, it comes out, we need this work done. And do I come to you or, and say, hey, Rex, we've got this problem. Like who quarterbacks the rest of that process to figure out, how much do we hold back? What needs to be done to get the money released? And I know it's probably too many variables and stop me if it is. But just in general, I'm kind of curious about that process.
Yeah, in general, your first conversation is probably with the loan officer as to what their policies and procedures will be to allow an escrow holdback per se. Each bank's going to be a little bit different. They're going to figure out what their risk tolerance is to make sure that things are taken care of. But from there, they can at least lay out the groundwork, any expenses that are associated, like re-inspections and stuff. They can explain all of that. And then it's probably the next step is obtaining, getting a contractor, get a bid put together so that you can figure that out. And sometimes you may have to get two bids. I know when we do escrow holdback here, it is two bids that we require because, again, we don't take a lot of control. We don't vet the contractor per se in an escrow holdback. Whereas on a rehab loan, we may not need multiple bids, but we're planning planning all the stuff ahead of time, and we are going to vet the contractor. That's just our policy on how we would handle those things. So it's just, yeah, if you get into knowing you're going to have some repairs that are going to be done, just know you're going to have a little extra work. You're going to have to reach out to some folks, get some people to inspect it, get some numbers put together. And then, then ultimately the loan officer will be kind of putting that together for you, or somebody from their bank will be putting that together. Some of them will hand it off to a rehab specialist or something like that.
And more time. I mean, obviously,
Yes.
if you've got a short closing date, especially if you're deep into inspections, we may have to extend that deal. Can the buyer, if assuming all goes to plan and we've got the quotes and you've got the escrow set up and everything's ready to rock, when they close on that deal, can the buyer still, assuming the house is habitable, can the buyer still take possession of the house and move in, or do they have to wait until everything's done? Oh, they don't have to wait.
Yeah,
Oh, that's good.
yeah.
Okay.
Yeah, I mean, obviously it depends on the type of work that's being done, and a lot of times we may even ask the contractor to put on their bid, is there any time the home has to be vacant to be able to move in or something like that? Because we do some of that stuff with septic systems, and we do some of that stuff with foundations. I have one right now. We're getting foundation quotes for a problem house, but we'll get it done. But I'd say there's a good possibility I'm gonna be living in the home while they're jacking it up to remove a wall. So
yeah. Well, it's sort of like, any relationship. If the buyer and the seller are both interested in making it work, odds are we're going to find a way through it.
Right.
If everybody's patient and willing to get creative. So that's fantastic. As most of you know, we do not run paid ads for our real estate company or for this podcast. We rely on word of mouth. So if you find any of this content useful, would you mind please taking a few seconds to give us a quick rating, and maybe a few seconds more if you're feeling generous to give us a review? I'd consider it a personal favor. Let's spread the word to other home sellers. Now, back to your regularly scheduled broadcast. Well, these are obviously some extreme situations we kind of got into, but getting back to just the regular appraisal process, do these programs, FHA, VA, USDA, and you can separate them out all you like, do they use the same appraisers as conventional, or is it a different school?
Yeah, now pretty much all your appraisers that will do those government loans are standard appraisers who also do conventional loans as well. And they get additional, designations, basically, FHA, USDA, they have to be rostered by FHA, is approved to be able to do those types. And then VA has their criteria. You kind of have to get on their list, and they do limit how many people they will allow in a certain area. VA does. So you only have a smaller pool of appraisers to work with there, but they are state licensed typically, and certified to do all conventional loans as well.
Okay. Do you have any particular feelings you'd like to express about any particular types of appraisers? Are they all basically, I guess mileage may vary, but are there any generalizations or broad brushes you can sweep or paint with on some of these appraisals?
I guess not all loan officers are the same. Not all realtors are the same.
Nope.
Not all appraisers are the same. But as a general rule, what I was just mentioning, probably the VA is the hardest one, just because they just don't have as many appraisers approved in their panel. That's by design. They limit that. And with that, it's, you may have an appraiser, you may only have a couple of appraisers that are going to cover a certain area. And, if they don't agree with your opinion of value or the condition of the home, there's not too many ways to fix that scenario, because there's not like another VA appraiser you can go get to come in and look at that property. So that's a little bit of a
drawback there, maybe.
It's a drawback with the VA process. And then, of course, aside from the VA one, FHA has a little bit of a drawback too, because the appraisal with FHA sticks to the property for 6 months. So if you get an FHA appraisal that's not favorable, you're kind of stuck with that appraisal with all VA or FHA buyers within that 6-month window.
So, with VA, I think you said they call it Tidewater, and we've certainly seen our share of those emails. It's a day ruiner for me as a listing agent. It's always right in the subject line too. Like I don't have to read it. I know it's a crappy email I'm about to get. But they do allow FHA, USDA, even conventional and VA, they allow appeals. It's just like Is there any advice you have for succeeding, or is it just sort of a snowball's chance?
Each of them are a little bit different. FHA, USDA, that appeal process really is a little bit easier if you can just flat out know that the appraisal's way off. I'm not talking like a couple $1,000s off, but I'm talking 25, 50,
Right.
$75,000 off. And I have seen that. There's a method to remedy that, and that's even conventional too. So Fannie, Freddie, FHA, USDA. When it comes to VA, you're kind of stuck, and I've been in that situation. We have fought with VA on that type of a scenario, and they really stand behind their appraisers.
Hmm.
So they're a team player, which is nice.
Good for the
However,
appraiser.
it could be a big hurdle. But the rest of them usually have some sort of a appraisal escalation type of scenario, where if you can present some very strong facts as to why it is drastically off. A lot of times we have had appraisals overridden. We've been successful at that. I've also been unsuccessful at that. So hopefully we don't run into those too often, but unfortunately it does happen.
So if you do get a low appraisal, if you're conventional VA or USDA, and you move on from that buyer, or the buyer moves on to a different lender or loan program, that old appraisal will not haunt you, but FHA will.
Correct. FHA, that appraisal will haunt you because it stays with the property. VA, the appraisal stays with the borrower. It does not stick to the property.
Interesting.
And USDA and conventional, they just kind of, you start over, a new file, new person, new appraisal,
Okay.
and you go down that road. We haven't had anything come back with appraisals that have been logged, because they do all log these things, and especially Fannie and Freddie, they've been collecting appraisal data for, I don't know, 10 years now or whatever it is. And, so they do have files from previous appraisals and previous information that's provided. And that's part of the conditions that appraisers see on a regular basis. It's like, we submit an appraisal to Fannie and Freddie because they do review these things too. They may come back and say, well, we have conflicting data from another appraisal or some other source of information. So it could possibly come up, but it's nothing like FHA's is. FHA is just flat out that appraisal stuck there. It's attached to the number that's assigned to it from FHA as soon as that appraisal was uploaded.
So in a crazy market like we've seen over the years, I mean, comps could legitimately rise in 6 months or less.
Yes.
But they're not gonna listen to us at that point, right?
You can dispute it. I have successfully disputed one FHA appraisal before, and we got it okayed. But it's
Out
a
of
lot
how
of
many?
layers. It's a lot of layers you have to go through, because aside from your own in-house underwriters, you have to get on board with you and they agree with you. Then they have to submit all of that to HUD, which is also FHA, and they have to review it and see if they agree with our underwriting decision as to why we think the value on the first appraisal is bad. That's rolling the dice more than once, and I can't seem to win the lottery picking numbers, so I don't hold my breath on these either. But there is escalation scenarios that can happen, but they do get difficult. So outside of that, the other remedies that we do see, unfortunately, and I've been the beneficiary of it, and I've also been the person who has lost from this, is
Right.
if you get a scenario, bad appraisal, because we know we just had a bad appraiser, sometimes you just got to switch lenders. You could switch lenders and start over, which unfortunately is delay. But if you can get another appraiser out there, and and I do have some local banks and other lender friends that have been in this. I mean, I've gotten that phone call from them. It's like, hey, we got so and so did our appraisal or whatever, and we'll pick the file up. We reorder a new appraisal, and we'll get it done. And I have seen that where I've had a really bad one too, and I've offered to help people get to where they need to go and get them to a colleague, someplace else that's outside of our network, to be able to get something accomplished. So,
Got it. So just for sellers who may not know or have never been through it or have nightmares about this, if you get a low appraisal, the seller doesn't have to take that number. I mean, it can be renegotiated either with that buyer, or we can kill that deal and move on and go look for another buyer. And but some of my sellers are concerned that, oh my gosh, if the appraisal comes in low, I'm stuck with that number. And it's just patently not true. So speaking of value, is there any data to suggest that since they're all using basically the same appraisers, can we assume then that across the board value isn't going to be wildly different based on maybe based on the appraiser, but not on the loan program? So in other words, FHA appraisals aren't traditionally lower than conventional or VA or any of the others. Is that fair to say?
Yes, that's accurate. I mean, they basically use the same gridding process, looking at condition, age, square footage, all of that. That process and that appraisal is the same no matter what loan program you're doing.
Okay. And, speaking of a few other things that are unique, in Ohio, we have this OHFA program, which I'm assuming you're familiar with. Can you kind of tell us what that is? Because we run into a lot of these.
Sure. Ohio Housing Finance Agency. And it actually kind of ties in with some other things too, grant programs and that type of stuff. Most folks are going to OFA, OHFA. First off, because they typically have grant money to help with down payment assistance or closing costs or something of that nature. That's a big draw. Other things are they're kind of almost a subsidized loan a little bit, and the interest rates tend to be a little bit lower. The offset to that is closing costs tend to be quite a bit higher, and mostly because there's a lot more fingers in the pot that have to go through these loans. So in the state of Ohio, OFA is basically funded and managed and serviced by US Bank. Not necessarily folks are going to US Bank, they just kind of back the OFA program. So when we underwrite a file, we do all our normal stuff we have to do, which you would normally do in that 30-day window or whatever your contract is. Once that's done, then that file has to be uploaded to OFA for them to review as well. And OFA's turn times have been really fluctuating over the years, especially busy season. They're really behind, and not so busy season, they're still a little bit behind. And at the end of the deal too, there's more closing costs because not only did your lender have to underwrite it, US Bank had to go through it, do their stuff. OFA has to be funded something so they can continue to operate. So some of that free money is what most people see it as, comes with additional cost associated with it. So that's kind of a setback. Second part of that is that type of a grant program typically is going to have some sort of lien on the property, like a second mortgage, which is going to possibly hinder that buyer from being able to refinance easily. I'm not saying they won't be able to refinance, but when they've got a second lien on there, all that stuff comes into factors with equity and that type of stuff. So if they're anticipating rates dropping in the short term, it might be harder for them to benefit from that. Although again, it can be done, it's just extra stuff that has to be done. But from the seller side of it really is understanding that it's going to be a little slower process. They're typically not going to close as fast as just a standard agency loan.
So is this something that sellers should be asking because I've yet to see a pre-approval letter come in that says, oh, by the way, or even an offer that says, oh, by the way, we're going through this OFA program.
Yes.
We only find out, let me just paint the picture for you. Let's see, 4 days before closing, when we're checking on to make sure the TRID went out and all that stuff, that's when I hear about it. Oh, OFA's running behind. Oh, this is an OFA loan, So at what point, how do sellers ask that question, and when should we be asking that?
At the time that you receive the offer, I mean, that would be a great question to reach back out to the buyer's agent or the buyer themselves. I see you're doing a conventional loan or an FHA, whatever it is, because OFA offers all of them. Just ask them, is there any grant money associated with it? Because that's a little more wide sweeping, not just OFA, but a grant program in general. Here in Ohio in the spring, we always have welcome home funds. In addition to OFA, and then there's other regional stuff that has grant money that becomes available. I know up in Sandusky, they had some grant money for a while. Lima's had grant money for a while. And it kind of comes and goes, but it's also subject to the availability of the funds. So some of those things, welcome home especially, they'll start taking those grant applications, but it might not be available for another month or 45 days or something or other to be able to get that funding available to actually take care of it. So asking that question is there any grant money associated with your loan, or are you going through OHFA? Just to give yourself a little more idea of what to expect in timeline, because even on the buyer's side, if you may have a buyer's agent, they might not even ask that, they might not even know it, and it might open up a great conversation to make sure everybody's setting the right expectations up front.
Yeah, that was because initially I would get really ticked off at the buyer's agent for not telling me, and then after 4 or 5 uncomfortable conversations, I would find out that buyer agent had no idea that this was
Right.
happening.
Right.
And, that stuff happens, and I think a lot of times that miscommunication comes when the buyer doesn't fully understand the implications of this free money they're getting and may not even think to mention it to their buyer's agent. And maybe the loan officer assumes that somebody told somebody. So if you were on the other end of that as a loan officer and you got an email from me and said, "Hey, Rex, I've got this deal coming together." They put your pre-approval letter with it. Would you mind telling me if there's grant money associated with this? That would be okay for you to answer that or not?
Probably not the correct way to handle that. Usually from that conversation, especially from a seller's agent that I'm really not familiar with, I'm going to reach out to the buyer's agent and the buyer, say, hey, they're asking, did you tell them? And they're going to tell me no. And like, is it okay if I tell them that, yes, we are using OHFA? So we're going to get permission, but more than likely they're going to say yes. I mean, they want their offer accepted. They want to
Right.
make sure they can get things done and not lie. And we usually get that done. So getting the proper permissions is the right thing to do first. And then, yes, getting that information out to the parties that really need to know it. Definitely do that.
So if I copy somebody from the buyer's camp, and we say that loosely because sometimes we're working with agents and sometimes we're working directly with buyers that we
Right.
don't represent. If I copied them, maybe that would soften the blow a little bit, or at least open the door for somebody else to answer the question.
Sure.
But what I wouldn't get is a flat out no if there were one. Like, you couldn't lie to me is my point.
No, could not lie to you. No,
Okay, excellent. I know you wouldn't, but yeah.
Right.
So certain condo developments I know we've run into, we get the question as soon as we list it, hey, is this condo FHA approved? How in the world would I know that, especially if it's an investor who has never lived there and has never known?
Right.
How would I find that out, especially if my seller doesn't know?
Easiest thing for you or a seller to do is just Google FHA approved condos or VA approved condos, because there are lists out there. And if you Google that, you'll find the VA website and you'll find the HUD website, and it'll take you right to it. And you'll put in the county, name of the association, whatever. I usually just pull up the county. That way I can scroll through to make sure I don't mistype something, because those two particular programs, if it's not on their approved list, you got some extra hurdles to get through, either a long delay to approve the whole association, or FHA does now have a spot approval program so that you could potentially get one specific condo in an association approved, but it does take extra time. That's probably not going to close in 30 days if we have to go down that path.
Okay. Well, that's good to know. I mean, it's just one of those things we run into like maybe 3-4 times a year.
Sure.
And many times the seller knows, and if they don't, that's when we sort of struggle a little bit. So we talked earlier about the FHA flip rule. Can you kind of tell me what that means?
Sure. So FHA is the only one out of that group that has a flip rule. And basically, there's two timelines. There's 0 to 90 days, and there's 91 to 180 days. From the time that the current owner bought the property till day 90, actually day 91, they cannot sign a contract with anybody that's going to use FHA financing, because they do not allow flipping. From day 91 out to day 180, the seller can sign a contract with an FHA buyer. However, it does require a second appraisal. The second appraisal cannot be paid for by the buyer, so the seller probably is going to be eating an appraisal cost. And you can't have the new sale price more than 100% over what the current buyer paid for it. So if they bought it for $100,000, they can't sell it for $250,000 in that first 180 days. After 180 days, it's just like normal. You just go through the process, but they go from the date the contract is signed, not the date of the closing.
So the old, we'll sign the contract today, but closing, that won't work.
That does not work for FHA.
That does not work. Okay. So this is all great stuff. Thank you for this, because these are things, especially as a listing agent, when you run into it and you have the deer in the headlights, it does not instill a lot of confidence into your sellers. So
Sure.
Very good for us to know this. As we kind of talk through this, what steps can a home seller take that will ensure that their property does? Is there stuff they can do before, I'm a big prep guy. I think that you make your money in a couple of places, and it's usually not during negotiations. You can certainly make some money during negotiations, but you mostly make your money when you prep and price and market the property. So kind of playing into that, is there anything any advice you can give to sellers as far as what they can do before they get on the market to ensure that they're open for all business, whether it's FHA, VA, USDA, conventional?
Right. I sent you my little cheat sheet, which I coach a lot of realtors with.
Time out. I do have it. I did get it, and I will link to that in the show notes as a PDF, if that's okay with you, Rex. I'll make it available that way. Okay. Yeah. So
absolutely. That probably covers 90+% of what we find on appraisal issues as far as the government loans are concerned.
perfect.
Outside of that, I have a lot of friends. I know a lot of folks in the industry that are home inspectors. There are several that will do pre-sale inspections. It's a great way for you to get an idea of what to expect in that process, and give you a heads up, maybe things you could do. Many of them are pretty well educated on the FHA programs, to be able to point out, it's like, this might get flagged, that might get flagged, and little things that you can fix up, preparing the home to go on the market. And that could get rid of a lot of headaches or last minute rushes to get something done, and give you a little more peace of mind as to what you're selling or what your potential buyers are going to be seeing when they come and see the property.
Absolutely. Sometimes a few $100s invested with whatever you find, either from your checklist or from a pre-inspection, are going to save you or make you a lot of money down the road. You're going to attract more buyers. You're going to have fewer problems. In the end, it's more likely to get to the closing table versus a property that has problems. Even if they're disclosed,
Right.
It's still a problem, and you're restricting buyers. And we have an internal truth. I did a whole episode on it that says, more buyers equals more money, period. There's just no way to dispute that. Most home sellers dread inspections and appraisal issues. Our digital course, Living to Listing, teaches you how to turn any property into the perfect listing, so you sail through inspections and appraisals, sell faster and for more money, and frankly, sleep like a baby. In Living to Listing, you'll get dozens of checklists, tools, and walkthrough videos from me for every step. And here's my promise. If this course doesn't meet your high standards, just let me know. I'll not only refund you, but I'll let you keep the course. You literally have nothing to lose. Check out the free videos at livingtolisting.com. Let me know what you think. Turning our sights back to the pre-approval letter that we referenced a little bit earlier, I know sometimes there is no template that I've ever seen as far as pre-approval letters go. So sometimes they say pre-approval, sometimes they say pre-qualification, sometimes they don't really say anything. But as a seller, what should I be looking for in that letter to tell me the strength of that particular buyer?
In general, and for the most part, a pre-qualification is really nothing. Because most of the time they might have done an application and they have pulled credit, but sometimes it's not even a full credit report. They may have only did a soft pull credit, which means it's limited information and it's not necessarily completely accurate. And so, you're really negotiating with somebody who really is not prepared to buy. A pre-approval really should be a full credit check. It should also be reviewing their income and asset documents to make sure they can afford it, make sure they got the money in their accounts. They don't have some strange deposit in their account for $50,000 last week or something like that. So pre-approval is definitely preferred over pre-qualification. And, I personally am dealing with some of this right now. I flip houses occasionally, And I've got one on the market for sale, and I've had two realtors bring me offers from potential buyers, and they attached the pre-approval. It wasn't a pre-approval. Let me back up. It was a pre-qualification. It was an online lender, a very popular online lender. And one of these agents was fairly new in the business for a few years. The other agent I've known for probably more than 20 years. And I looked at it and I called both of them back because right in that letter, if they just read it, aside from the bold print that says pre-qualification, if they read the rest of it, it said right on there, this pre-qualification is based on stated information from the borrower. Well, 2008, the big crash that a lot of us know about, was all about these, what they called subprime loans, and they put a negative connotation on that. One of the big ones they hated was stated income, stated assets, no income, no asset loans. And that's exactly what these things are. It's just stated information that, and they're assuming their buyers are not lying to them. But unfortunately, that's the recipe for a disaster later in the transaction. In my business, I get a lot of those after they've gone into contract and things aren't going well, and they're trying to figure out how to fix or undo all the bad that was done by not doing due diligence up front. So pre-approvals only, never accept a pre-qualification, and ask the question, can you get something from your lender that states that they have reviewed your credit, your income, and your asset documentation? If they have done all of that stuff and they still stand behind their pre-approval, you've got a much higher percentage of success of getting that thing closed.
As a seller's agent, we do ask these questions, and whether or not they're supposed to answer them, I have no idea. But I always copy, like I said, the buyer's camp when I ask these questions, because especially when we're in heavy negotiations, it's nothing for us to get half a dozen or even up to a dozen offers on a property if it's priced well, in a tough area where it's hard to find property. And at that point, whenever I get the offer, I immediately email the lender a copy of their letter, and I ask these same questions. So, because sometimes the letter is pretty vague, I assume that's intentional, but I don't know. I mean, is that like office policy? Like, does UHM have a policy on what can be on a letter, or is that kind of up to the individual loan officer?
A little bit of the individual loan officer and a little bit of strategy on the buyer's side. And we have several different templates for pre-approvals. My agents, when I pre-approve, I call the buyer's agent and we discuss kind of how the conversation went with the buyer. And they know, we start off with a kind of a generic pre-approval, with a to be determined address or whatever. But they all know that if they need something more specific, the address on there, the price on there, concessions on there, any of that stuff, we'll do that as kind of a secondary step. It's not just a broad sweeping, because most buyers don't want to walk around with a pre-approval that says they can afford $300,000 when they're trying to negotiate a $225,000 purchase price. It is a negotiating tactic, I guess, in the whole process, but that's also why you represent your sellers exceptionally well, because a lot of listing agents do not make that phone call. They do not make that connection. They do not reach out to verify this information is accurate. I only probably get maybe 10 agents a year that will call me from the listing side and ask me to verify that pre-approval is strong.
I raise holy Cain around here if it doesn't happen. And here's why. I mean, every rule we have, every play in our playbook, and this is like the benefit of decades in the business, and you get a lot of scars, right? If I weren't in this lovely shirt, you'd see an awful lot of bullet holes. And not literally, please, for those that are listening. But the point is that when I get burned by stuff like OHFA, not knowing that there's a big difference between a pre-qualification and a pre-approval, it goes into the playbook. We're just not going to deal with it anymore. I got burned one time 5 years ago by a municipal point of sale in an area that I didn't know had them. Some little tiny little town in Southern Ohio. Nobody in Southern Ohio was doing these. They're not doing them anymore, but they were then. They played with it. I didn't know, and it cost me a delay at closing. So at that point, every single deal we put under contract, I asked somebody to verify what's going on with the municipal point of sale. And 99.9% of the time I get, what are you talking about? There is no such thing. That's fine. But I will never get burned by that again. And that's
Right.
why these conversations happen. And as a seller, you might, if you're a retail seller, you're only going to sell a house every few years, maybe at the most. I mean, how are you expected to learn all this stuff? You could hire me, of course, but there's I want people to walk away from these episodes with real knowledge that they can take out and use. And so that's kind of where we're headed. So if we can ask those questions and really clarify until we're comfortable, I think so much the better, because better to find out before you sign that offer than say 15, 20 days later when you haven't heard from the lender and you find out they switched lenders because they couldn't qualify, and et cetera, all the nightmares.
Right.
Well, thanks for breaking that down for me. So what I heard was pre-qualification, a ham sandwich with a pulse could get a pre-qualification. Is that about right?
Yes, that's pretty much it. Yes.
Fair enough. So is there anything from a negotiating standpoint that would help a seller? Is there any difference, I guess, between a government loan and other than stuff we've already talked about, government versus conventional? I've got sellers that will, like I said, insist that a buyer switch to another program. That's probably a bad idea, because if I heard you right and my notes are accurate, you may actually get more money out of some of these government buyers.
Yeah, absolutely. I work in a lot of rural areas, so we do see multiple offers, but we also see I see a lot of houses that are right now they're doing price reductions, $5, $10, $20,000. I mean, why wouldn't you open that up and start showing it to other people before you start cutting your,
I don't know.
cutting out of your wallet?
I don't know.
So yeah, but there's definitely benefits, to looking at all of them and then looking at the whole package. Look at the lender, look at the loan officer. If there's, if you have a relationship to understand who they are, that really has a lot more to do with successful closing than it does the actual loan program.
You mean the loan officer or the bank?
Both, because I mean, I know of not so great loan officers that work for good banks. I know some great loan officers that work for not so good banks. And then occasionally you find the ones that have matched up at the right place, the right place, the right time, the right people. And, they do exceptionally good, and their batting average is extremely high. Now, unfortunately, there's no grade cards out there that you can go look up and see what their percentage of close successfully is. But, if you have reference to anybody else that may have worked with that lender or that whatever, within the real estate community, most of them have a pretty good idea who has a good success rate and who doesn't. And then also, again, if you've got a lender that handed you a pre-qual and say, go look at houses, you probably aren't even working with the right lender to begin with. And that's a great sign that, they're not prepared. They don't understand the entire process, completely. And that's, just giving you one more opportunity to have some downfalls in your transaction.
Well, I mean, to your point, the same is true for realtors. There's no national registry of who's a really great agent and who's not,
Right.
So what we've done over the years, and I've been doing this for a long, long time, is everybody I work with, honestly, there's a chunk of my database that some of those people probably aren't even alive. A lot of them aren't in the business anymore, but guess what? I got notes on them. So if
Yeah.
they happen to show up on my radar again, I will go back into my database and we keep copious notes on how the whole deal went. How was the attitude even of the realtor, the inspector, the appraiser, everything we can track, we track, because again, I don't want to get burned. At least if I know this person is a bit of a jerk or doesn't return phone calls or, things like that, at least I could kind of plan for it and give my seller a heads up before they take the offer. But there's so many new lenders and so many new loan officers out there that many times we're coming up empty.
Right.
Even on a Google search, sometimes we can barely find anything beyond the fact that they're real.
Yeah.
So any advice there other than I like this? I mean, if they send us a pre-qual, especially with the line, go out and shop, we know we're probably dealing with someone who's maybe going to give us a little bit of trouble down the road.
Well, yeah, you're definitely opening yourself up to some potential problems. It's not every time, but it's definitely a sign to be aware of. And what you're doing, I coach realtors and real estate offices all the time, because as a buyer's agent, one of the hurdles that they have to contend with for compliance and liability is, we can't steer somebody to a lender. We got to give out 3 names and whatever, and that's great. But I asked them all, it's like, are you tracking? I mean, you have an office of 30 agents. Are you guys tracking, the percentage of, the closing percentages,
Yeah.
if the bank brings these in, how many are actually closing and how many are not? Because you don't have to steer your client, but if you can give them historical data of your office of who you've been successful with or not, they can come up with their own decision out of that without you telling them where to go.
For
And
sure.
so there's not a lot of agents that do that. So kudos to you and your team for offering that to your sellers, because I think that a successful real estate brokerage should be doing that. And
I'll,
unfortunately, a lot of them don't.
I'll tell you the other thing, even if we don't, and thank you for that, by the way, even if we don't know them and we do some due diligence and we come up empty, sometimes the email itself is a test. You know what I
Yes,
mean? Like if I email, let's say I get everything I need, it's a solid pre-approval and they've disclosed a home sale contingency, like it's really, really solid. I'm still going to email them because we track how well they respond. And I'm not talking Sunday night test. That's not even fair. But
right.
if I've gone a day or two, especially if we're in multiples, and I have not heard anything from the lender after my email and follow-up email, then
Yeah.
another red flag,
Yes,
that's probably a sign of things to come because typically to what you mentioned earlier, they want that deal to get accepted. Well, if they're not excited during the offer, I'm going to have a lot of trouble getting them excited as we get closer and closer to closing.
all
So
right.
sellers, that's if you have nothing else to go on, just secret shop them, see how they do on some of this stuff. And maybe that will give you some insight. Same with realtors because I'll ask if I can't find anything on the lender, I'll ask the buyer's agent, what do you know about the lender? Some are very honest and will say, I don't know anything, Glenn. I'm sorry.
Right.
Some will say, oh, I've closed, dozens of deals with this person. Then I look up the realtor and find out they haven't even closed dozens of deals themselves. So, liars lie. That's one
Yes,
of our
yes.
office phrases. So you got to be somewhat careful and just kind of use common sense as we go through some of this. Well, okay. One thing I'm throwing in pretty regularly these days, just based on the news, and I think you probably know this is coming, but are you seeing any impact or macro or micro changes to the real estate industry or even to the loan industry based on all the NAR lawsuits and settlements and stuff that's happening right now? Any thoughts on that?
Um, yeah, and it's a weekly update within our company on this. It's so new. I mean, it
Mhm.
just now finally got implemented. There was a million what if scenarios that happened before I don't know, it was August 15th or whatever date that thing started. And now that it's in
17th.
play, everybody's still scrambling, trying to figure out how to make this work. And there's in the state of Ohio, I can't even count how many different documents have been generated to try to fix this or comply with this. There's no fixing it, but it's full disclosure. And from the seller side of it, negotiating out the realtor commission. If there is also buyer concessions, make absolutely certain those are 2 separate discussions on your purchase agreement, that they are very clear what's being paid for the realtor and what's being paid to the buyer if for concessions if they're being asked for.
Why is that?
There's some compliance issues from the agencies, so Fannie, Freddie, FHA, USDA, VA. This literally just came up yesterday on our call, and we kind of thought, and some realtors thought, you could just do kind of a blanket concessions. Let's say we're going to do 6% because FHA USDA allows 6% of the purchase price for seller
Okay,
concessions.
fair enough.
Conventional can range anywhere from 3% to 9%, depending on some variations. And VAs, I don't want to say it's unlimited, but it's kind of unlimited. It's they have their own little thing. The problem is especially lower price ranges, maybe you got an FHA borrower who needs 6% seller concessions just for their closing costs.
Hmm.
And then you got your buyer's agent also requesting money to cover their
Their
commission
fee.
in that
Hmm.
transaction. You can't do a blanket 8% or 8.5%, because if you do it as a blanket, now you're out of compliance because it makes it look like the buyer's going to pay the agent and they're going to take it out of concessions. And if we're going to take it out of concessions and the buyer's paying for it directly to their agent, then the seller concessions exceed what's allowed. If the seller is truly paying the buyer's agent, then it's not a cost to the buyer, and we got to keep the buyer's portion within that, let's say 6% on an FHA deal.
I got it.
So that there's some tiptoeing around with that, and I've sat through a couple of NAR discussions at one of the real estate boards that I sit on. I'm in 3 of them, and all 3 of them are different. But one of the discussions that they did come up with was lumping together these numbers. And a lot of realtors also are struggling with whether or not their buyer's agent commission gets counted against the seller concessions that a buyer can ask for. So just being clear, just separate those fees.
So as you know, I sit on the seller side 99.999% of the time. And, this is not a question we have asked. I made a lot of notes on this, and I'll probably make some more later because I'm going to call some buyer agents that I work with a lot and kind of get the lay of the land. To your point, this is emerging. August 17th was, oddly, it was a Saturday. And then this is when all this stuff happens.
Right.
And so, but it happened. And so we're seeing everything. We field a lot of offers every week. So, because we have a lot of listings. And I see almost all of them. But what we see is kind of a mixed bag. Sometimes I'll get a separate buyer agent commission addendum. Sometimes it's spelled out in the additional terms, seller to pay, buyer agent, blah, blah, blah. And then there'll be a separate concessions line. But to your point, sometimes we get it where it just says, X percentage or X dollars in, closing costs to the buyer. And we don't know what's what. So from my end, at least according to my crack team, we don't need to know. But I kind of think I do need to know if it's going to create a problem down the road. And so what we don't want to do is have to go back and renegotiate this later, because that would be very difficult. It can be very uncomfortable when we have to do that. I mean, not for me, but for everybody in the deal. And when the heat goes up on the deal, it affects everyone. So would it be fair? Well, I don't know if you can even answer this. Would it be fair for me to ask the lender? No, that wouldn't work. I would have to ask the buyer's agent how much of this is going to you, and they're not going to want to answer that. So this is kind of a losing.
Well, they might not want to, but at the end of the day, they're going to have to.
They're going to have to.
Because it'd be beyond your side of it, my side of it. There's a couple of other people that have to know this stuff now. The title company, for one, because how they fill out the settlement for the closing disclosure is going to differ. If the buyer's paying the buyer's agent, it's got to go on the buyer's side, and that may or may not come into play with their concessions. If the seller's paying the buyer's agent's fee, it needs to get posted on the seller's side. So that's part of the title company needs all this information, have an accurate closing disclosure up front. Okay. Beyond that, then, you guys are putting this information out there in MLS after closing, and appraisers are utilizing this information because they are tracking concessions. And I don't know for sure if appraisers are breaking out buyer agent concessions.
I don't know how they could. I mean, because there's no field for commissions anymore. Even on the closing side, there's no way for me to mention, hey, by the way, half of those concessions went to commission. We would water them out if we knew, and just say let's just say it was 100 apples. I would say 50 apples went to and then I would only list 50 for the concessions, because I know that. But if I don't know that, then I don't know that, and then it's gonna hurt the appraisals in that area, though, isn't it? Or affect them anyway.
It could affect them. Absolutely could affect them. And, so there, again, this is part of that learning curve we're in right now. They don't have this ironed out yet. I'm sure there's going to be some complaints and maybe some legal action, who knows? And it really is just about being fully disclosing up front. For the most part, I'm seeing that, buyer's agents are going, a lot of contracts I've seen do have the buyer's agent fee and who's paying it. And that's helping. but not all contractors showing that, or they have a separate addendum, like you had mentioned, which they may or may not feel that they have to do. So it's just being, I'm recommending clarity, because if everybody stays in their lane and it's all written out in black and white, there's no question asked, and there's no figure out how to fix something or pay somebody who thought they were getting paid, but they're not because they didn't put it on paper.
Yeah. Well, either way, it all comes out on the HUD eventually, or on the Alta.
Yeah.
At least it's supposed to. So, well, look, this has been super fascinating. And I feel like I've taken up enough of your time. Thank you so much for giving it. Is there anything I missed that you wanted to talk about? Any topics we skipped over that you really wish we had gotten to?
I think we've kind of covered all of our points that we were hoping to hit here.
Yeah, I think so.
I appreciate this time. I appreciate what you guys do. I think you guys handle your clients exceptionally well. I get to work with a lot of realtors all over the place, and some are very organized and some are not. And you're on the very organized side. So,
well, and to pay that compliment back, I mentioned this in the intro, but you've done loans for my family, multiple loans for my family and my kids. So it's not like you're just some guy I had coffee with and decided to do a podcast. We've known each other for years and have actually done business together. And that there's a reason I called you and not the other 9,000 loan officers we have in our database, even the good ones.
I appreciate that.
So if people want to learn more about these programs, or maybe learn about working with you and Union Home, where would you have them go?
Probably the easiest to remember and find me is on the web. My website is applywithrex.com. And of course, I have my office phone number. It's 567-998-4276. And if you look up Rex Grasz Union Home Mortgage on Google, you'll find us on there with lots of reviews, and it'll kind of link you right into my offices. We'd definitely be glad to help you out.
Well, we'll link to all of that in the show notes as well. But if folks are driving and hearing it, applywithrex.com seems to be the catch, the best opening to find you. So hopefully lots and lots of people will go there. But Rex, it's been an absolute pleasure. Thank you again for your time, and I'll be talking to you soon.
Sounds great. Thank you.
Thanks for sticking around. Hopefully you learned a lot today. Rex always is a wealth of information, and hopefully you had a little bit of fun. If so, please share this episode with somebody, or on the socials. Feel free to tag me and Rex if you do. By the way, if you have any questions or topics you'd like to hear in future episodes, I would love to hear from you. Check the show notes or head over to talkingrealty.com for our contact information and say hello. Thanks again for tuning in. Until next time, keep making smart moves in your real estate journey. For the Ohio Property Group, this is Glen Whitten signing off. And remember, you can sell it. We can help.